Hey guys, tonight we're diving into a big question. How should you treat your investments? Do you see them as a farm, something to nurture and grow over time? Or do you view them as a casino, hoping for the quick thrill of a lucky win? Well, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. Seriously? You don't have to do it just because I asked. And go ahead. Post your location and local time in the comments. I love seeing where everyone's tuning in from. Now, dim the lights. Maybe turn on a fan for that soft background hum. And let's ease into tonight's journey together. We're going to start by comparing two different approaches to investing: the mindset of a farmer versus that of a gambler in a casino. Right now, picture yourself sitting at the roulette table in Vegas. The lights flashing and the adrenaline pumping. It's all about the thrill, isn't it? But what if I told you that treating your money like a gamble is the fastest way to end up broke? You see, there's a vast difference between investing for long-term growth versus trying to make a quick buck. In the world of investing, people often get caught up in the idea of quick rewards. The stock market has its ups and downs, and that creates a lot of excitement. But this excitement can quickly turn into a trap if you're chasing after quick profits like you're at a blackjack table. Many investors buy into the hype of the hot stock, hoping it will explode overnight. But this is the same as betting your whole paycheck on a roll of dice. Sure, it's thrilling for a second, but you're just one bad move away from losing everything. Now, let's switch gears to the farm. A farm isn't about instant gratification. It's about nurturing your crops, tending to them consistently, and patiently waiting for them to grow. Sure, there are risks. You can't control the weather, and sometimes you'll have a bad season. But you don't just give up and sell your farm when that happens. Do you? You wait for the next season. That's the beauty of farming. It's about playing the long game, nurturing your investment, and watching it grow over time. So, if you want to know how to stop treating your investments like a roulette wheel and start seeing them as a farm that'll pay off in the long run, stick around. We're going to dig deeper into why long-term thinking is the key to a steady financial future, and why patience is, without a doubt, your most powerful tool. Now, let's talk about something that often makes investors sweat a little: patience. If you're looking to treat your investments like a farm, you've got to have patience. Just like a farmer doesn't expect to see the fruits of his labor overnight, you can't expect your wealth to grow in a matter of weeks. You might think you've got the next big stock tip, but the reality is, there's no such thing as an overnight harvest in the world of investing. Remember when you planted those little seeds in elementary school? You probably put them in a little cup with soil and watered them daily. But did you stand there and expect them to sprout instantly? No, you had to wait. You had to nurture them. And when they did finally poke through the soil, you had this tiny, fragile little thing that needed even more care to grow strong and healthy. Investing is the same way. It's all too easy to get wrapped up in the quick returns that a market pop or a speculative stock offers. But trust me, that's no way to build wealth. You might make a quick buck, but just like that seedling, it can be fragile. A poor decision or an unforeseen market shift can wipe it out. So, why do people still try to rush the process? Historians still argue whether this culture of instant gratification started with the invention of fast food or the rise of social media. But the truth is, we live in a world that expects things quickly. You're sitting there, thinking, I want to retire in 10 years. I want my investments to explode now. But here's the thing, plants don't grow overnight, and neither does wealth. Sure, you might hear about some young whippersnapper who made a ton of money with a hot stock tip, but that's rare, and it doesn't mean you should throw your hands up and start chasing after the same thing. Most successful investors are in it for the long haul. They plant their seeds, whether that's in a diversified portfolio, bonds, real estate, or a strong blue chip stock, and they let it grow, slowly and steadily. What I'm getting at here is simple. Stop worrying about getting rich quick. Start thinking like a farmer who knows that a healthy crop takes time. You're not going to see immediate results, but if you're consistent, over time, your investments will grow and flourish. This is the secret that many successful investors, including myself, have learned over the years. There's no shortcut to real wealth, just a lot of patience, a little luck, and some good decisions along the way. All right, so now that we've established the importance of patience in farming, Let's explore the next essential idea in this long-term journey: how your wealth grows slowly over time, just like a crop. If you expect your investments to grow at the same pace as your impatience, you're setting yourself up for disappointment. Remember, farming isn't about watching things sprout and bloom in an instant. It's about carefully cultivating your crops and watching them evolve steadily, day by day, month by month. In the world of farming, there are no instant crops. You plant seeds, and you tend to them day in and day out. You might not see the immediate fruits of your labor, but you know they're coming. Similarly, your wealth is going to grow incrementally, step by step, as you continue to nurture it. Sure, it may be a little slow at first, but when you look back after a few years, you'll be amazed at the progress you've made. One of the hardest parts of being an investor is watching your portfolio grow slowly. You might think, is this it? Is this all the return I get after working so hard? But this slow and steady growth is actually a great thing. It means your investments are working for you over time, like a field of crops slowly growing taller. It's that constant, incremental growth that will eventually lead you to the big harvest. We can take a lesson from the tortoise and the hare here. The tortoise might seem like the slow, steady one who's going to get nowhere fast, while the hare seems to be racing ahead, full of energy. But what happens in the end? The tortoise wins. Slow, consistent effort pays off. The same principle applies in investing. In fact, this idea is backed up by one of the greatest investors of all time, Warren Buffett. His strategy has always been about buying solid investments and holding on to them for the long haul. You won't see him jumping from one stock to another, hoping for a big payoff. He knows that the secret to long-term wealth is slow, steady growth. Over time, his investments compound, and he reaps the benefits of this consistent strategy. The key is to remain focused on the long term. While the stock market can feel like a roller coaster, you have to remember that it's the steady rise over time that really counts. Investors who think they can jump on every trend or every hot tip are chasing fleeting opportunities. But successful investors are the ones who are patient, focused, and dedicated to slow and steady growth. So, as you continue your investing journey, remember that it's not about rushing to the finish line. It's about building your wealth one decision at a time. Let your investments grow slowly, like a farmer tending to his crops. And when the time is right, you'll be able to enjoy the fruits of your labor. Now that we've talked about the slow and steady growth of your investments, let's touch on something just as critical: risk management. A farmer knows the weather can change at any moment. He can't control the rain, the drought, or the storms, but he can manage his risks. And that's the key to successful farming: knowing how to handle whatever comes your way. The same goes for investing. You can't predict everything that will happen, but you can take steps to reduce the risks and prepare for the unexpected. In the world of farming, risk is part of the job. No farmer goes into the season thinking they'll be immune to a bad year. Whether it's a crop disease, a late frost, or an early storm, the risk is always there. But good farmers take steps to protect themselves. They buy crop insurance, they diversify their crops, and they know which plants are more resilient in tough conditions. In other words, they manage risk. They don't eliminate it, they simply find ways to minimize it. Now, let's apply this same principle to investing. It's easy to assume that if you're not taking big risks, you're not going to make big gains. But that's a dangerous assumption. You see, there's a big difference between taking calculated risks and gambling. Investing like a farmer means understanding the risks involved and making smart decisions to mitigate them. For example, you wouldn't plant all your crops in a field that's prone to flooding, right? The same logic applies when you're managing your portfolio. Diversification is your crop insurance. If you only invest in one asset, whether it's stocks, real estate, or anything else, you're putting all your eggs in one basket. And when that basket falls, you're left with nothing. Instead, a diversified portfolio, like a diversified farm, gives you a cushion. If one crop fails, you've got others that are thriving. Similarly, in investing, if one sector hits a rough patch, others in your portfolio may be doing just fine. Let's look at the historical example of the 2008 financial crisis. The market took a major dive, and a lot of investors lost big. But for those who had a diversified portfolio, the damage was a lot less severe. They may have lost some, but they didn't lose it all. And here's the thing: Managing risk doesn't mean avoiding risk altogether. It means being prepared for the inevitable bumps along the road, just like the farmer expects a few bad seasons. A smart investor anticipates downturns and makes plans to ride them out. In the end, it's about knowing your own risk tolerance. Some people are willing to plant risky crops and hope for a big payoff, while others are more conservative and prefer the steady growth of more reliable investments. The important thing is to make sure you're not blindly gambling your money, hoping that everything will go your way. Instead, treat your investments like a farm, where you're managing risks and preparing for both good seasons and bad ones. With the right approach, you'll be ready to weather whatever storms come your way. Let's talk about diversification, a concept you've probably heard about a million times. You know the saying, don't put all your eggs in one basket. Well, if you're treating your investments like a farm, this advice is more important than you might think. The beauty of farming is that you don't rely on just one crop to feed your family. You plant a variety of crops, some that mature quickly, others that need more time, and some that can handle a little more risk. This way, when one crop struggles, the others can make up for it. The same logic applies to your investments. Imagine you're a farmer. You've got a field, and instead of just planting corn in that entire field, you decide to plant a mix of vegetables, grains, and maybe even some fruit trees along the edges. If a storm comes through and wipes out your corn, your peas might still make it. Maybe your apples survive the drought, and your beans thrive in the rain. The diverse mix of crops ensures that even if one type doesn't do well, you still have others to harvest. Now, why is this so important in investing? Think about it this way. The stock market isn't a single entity. It's made up of different sectors, industries, and asset classes. If you're only invested in tech stocks, for example, and the tech sector takes a hit, you're in trouble. But if you also have some investments in bonds, real estate, or even international markets, your portfolio is more resilient when the storm hits. Diversification isn't about throwing everything into a bunch of random stocks or assets. It's about spreading your investments across different types of assets, stocks, bonds, real estate, commodities, and other vehicles that behave differently in various market conditions. When the market is soaring, some sectors may do better than others. But when things take a downturn, the more stable sectors in your portfolio can help keep you grounded. Let's look at a historical example. During the 2000s, the U.S. stock market went through a rough period first with the dot-com bubble burst. And then with the 2008 financial crisis, investors who were solely focused on the stock market had a tough time, losing substantial amounts of their portfolios. However, those who had diversified into other areas, such as real estate, gold, or international stocks, fared much better. They didn't escape unscathed, but they didn't lose everything either. Now, here's where it gets interesting. Diversification doesn't just protect you from market downturns. It can also help you capture growth in different sectors. For instance, while tech stocks might be booming, the real estate market could be lagging behind. But in a few years, when the tech sector cools down, real estate could be the one heating up. If you've planted a variety of crops, you'll be ready to harvest when the time is right. Remember, just as a farmer wouldn't bet the farm on one crop, you shouldn't bet your entire portfolio on one asset. Diversify so that no matter what the market throws at you, you're prepared. Let's shift gears a bit and talk about something that every farmer knows all too well: the changing seasons. Just like the weather can change unexpectedly, the market has cycles that investors need to recognize and adapt to. But how do you handle the changing conditions when your crops and your investments are in full swing? You see, farming isn't just about planting crops and walking away. It's about knowing the right time to plant, when to water, when to harvest, and when to brace for the inevitable bad weather. Similarly, in investing, you need to understand that there are seasons of growth, seasons of rest, and seasons of adversity. The stock market is no different. It has its booms, busts, and everything in between. Just like farmers rely on their knowledge of the seasons, knowing when to plant crops and when to harvest, you, too, need to be aware of the cycles in the market. You can't control when a recession will hit or when the market will surge, but you can control how you respond. One of the most important things an investor can do is recognize which season the market is in. Let's take a historical example. If you look at the 1980s, The stock market saw massive growth during that time, an extended spring season, where everything was blooming. But then came the 1990s, with a market downturn, where a lot of investors saw their portfolios take a hit. The market was cooling down, just like a fall harvest. For those who had the wisdom to adapt, they pulled back, reassessed, and then positioned themselves for a market rebound. This cycle of growth, cooling, and rebounding is as natural as the changing seasons on a farm. Understanding these cycles is crucial because it's easy to get swept up in the moment. When the market is soaring, it can feel like everything is always going to be great. But as we all know, things don't stay the same forever. Just like the farm goes through periods of rain, drought, and sunshine, the market will have its ups and downs. And just as a farmer plans for those dry spells, you need to be prepared for the market's downturns. If you're constantly chasing the next hot stock or riding on the latest trend, you're at risk of being blindsided by the inevitable winter season, the market correction. Adapting to market cycles also involves understanding the concept of rebalancing. Just like a farmer would change what crops they plant depending on the season, you need to reassess your portfolio to make sure it's in line with the current market conditions. If one of your investments is thriving during a particular cycle, you may want to shift some of your gains into other investments that will benefit from the next cycle. Rebalancing is a simple concept, but it can have a huge impact on your long-term growth. Just as smart farming practices can lead to a bountiful harvest year after year. By recognizing the seasons of the market, you're not only protecting yourself from the inevitable downturns, but also positioning yourself for growth. And just like a seasoned farmer who's seen enough weather changes to know when it's time to harvest, you'll learn to spot the signs that tell you when it's time to invest more or when it's time to pull back and wait for the next opportunity. Now that we've explored how market cycles resemble the changing seasons, let's dive into something that's equally as important: emotional control. A farmer doesn't panic when a storm rolls in or when a dry spell stretches longer than expected. Instead, they take a deep breath and adjust their strategy. The same should be true for you as an investor. Emotional control is a crucial skill when treating your investments like a farm, because just like you wouldn't start tearing up your crops when the weather isn't ideal, you shouldn't make impulsive decisions based on short-term market fluctuations. One of the hardest parts about investing is keeping your emotions in check. The market can be an emotional roller coaster, and it's easy to get caught up in the excitement when the market is soaring or to panic when it's plummeting. But here's the thing: when you let emotions drive your decisions, you start making rash choices that can harm your long-term growth. You might sell off a promising investment in a panic or jump into a risky stock because it's been making waves. Let's think about it in farming terms. Imagine a farmer sees his crops starting to wilt during a hot summer. Would he rip everything out of the ground and start over just because he sees a few signs of stress? Of course not. He would take a step back, assess the situation, and make adjustments. Maybe he needs to water more, or perhaps he needs to protect the plants from a heat wave. But he would never make hasty decisions based on panic. Similarly, you shouldn't let fear or greed control your investment choices. Historically, the market has been filled with emotional investors who overreact to short-term news. During the dot-com bubble of the late 1990s, for instance, investors poured money into tech stocks simply because they were hot, with little regard for their long-term prospects. When the bubble burst, many were left with massive losses. A more patient, controlled approach would have allowed these investors to avoid the pitfalls of that speculative frenzy. They needed the emotional control to recognize that a quick rise doesn't guarantee a stable future, and sometimes it's better to sit tight and wait for the dust to settle. Similarly, during the 2008 financial crisis, many investors panicked, selling off their stocks at rock-bottom prices. But those who were able to stay calm and ride out the storm were rewarded when the market rebounded. Warren Buffett, one of the most successful investors of all time, famously said, "Be fearful when others are greedy, and greedy when others are fearful." It's this kind of emotional control that allows you to take advantage of market downturns and capitalize on opportunities that others might miss. Emotional control also comes into play when it comes to keeping your long-term vision intact. It's easy to get distracted by the noise, the breaking news, the sensational headlines, the stock tips from your friends, but these distractions can lead you down the wrong path. Instead of following every market trend, Take a step back and remember your farm analogy. It's about steady, consistent growth over time. If you stay focused on that, you'll be far more likely to make sound, rational decisions. Remember, emotional control in investing is like the farmer's calm, steady hand on the plow. It allows you to make thoughtful decisions, keep your focus, and navigate through the good and bad times with poise. With a clear head, you can see the bigger picture, avoid impulsive mistakes, and stay on track toward your long-term financial goals. Let's shift gears a bit and talk about compounding interest, perhaps one of the most powerful forces in investing. Just like a farmer's crops multiply as time goes on, your investments can multiply if you let them grow through compounding. This is one of the best parts of investing, and just like a farm that thrives with careful tending, your money grows exponentially when you allow it to compound over time. But like farming, compounding requires patience and the understanding that growth doesn't always happen in the blink of an eye. In farming, the more you care for your crops, the more they grow and the more they produce. Think about it. The first year, you plant seeds and you get a harvest. The second year, those seeds you planted last year might be bearing fruit, and you're planting even more. Over time, this cycle continues, and the return on your efforts multiplies. With each new harvest, you have more to work with, more to grow, and more to reinvest into your farm. This is compounding in action. When it comes to investing, compounding works the same way, but it's a slow process, and most people don't realize the power of compound interest until they see the results. You're not going to see your money grow overnight, just like you don't see a tree grow in a single day. But over time, with consistent contributions, your initial investment starts to compound, and those early returns start working for you. Before long, what started as a small seed of investment has turned into something far more significant. Warren Buffett famously said, "The most important thing to do if you find yourself in a hole is to stop digging." Well, compounding is the opposite of digging a hole. It's about digging a well. You plant that first seed, and over time, your investment returns, whether from interest, dividends, or capital gains, are reinvested, which in turn generates even more returns. It's like watering your crops daily and watching them multiply as you continue to nurture them. But the key here is time. You can't expect your money to compound if you're constantly pulling it out or making withdrawals. Farmers don't dig up their crops before they've fully matured, and you shouldn't be pulling out your investments before they've had time to grow. Compounding works best when you let your investments grow undisturbed, reinvesting any returns back into the mix. Over time, you'll see your returns start to snowball. The longer you leave your money to compound, the bigger the snowball gets. Take a look at a simple example. Let's say you invest $1.00 at an annual return rate of 5%. After 1 year, you'll have earned $50. Now, in the second year, you're not just earning 5% on your initial $1.00, you're earning 5% on the $1.90. And in the third year, you're earning 5% on $1.50. This is the magic of compounding returns on top of returns. It's like planting a tree that keeps sprouting new branches, all of which grow stronger over time. Historically, investors who've practiced patience and let their investments compound have reaped incredible rewards. One of the best examples of this is the way Buffett himself has grown his wealth. While his wealth didn't explode overnight, he took advantage of the power of compounding by reinvesting his earnings and staying committed to long-term growth. He understands that time is his ally, and by allowing his investments to compound, he's been able to build a fortune that most people can only dream of. So, when it comes to compounding, the lesson is simple. Be patient, stay consistent, and let time work its magic. Just like a farmer watching their field grow season after season, you'll see your investments bloom and multiply if you allow them to do so over time. Let's talk about something else that can be an investor's greatest enemy, the hot tip. Just like a farmer wouldn't suddenly abandon a reliable crop to chase after a flash-in-the-pan crop that's only trendy for a season, you shouldn't chase after the latest stock tip that everyone's buzzing about. It's easy to get distracted by the latest hot investment. But just as a farmer needs to stick to what they know, so do you. We've all been there. Someone tells you about a stock that's going to skyrocket or a cryptocurrency that's the next big thing. It's tempting, right? But the thing is, These hot tips are like the flashy flowers in a field that bloom brightly for a short while and then wither away. They might look appealing at first, but they don't have the staying power to withstand the test of time. And if you plant too many of those short-lived flowers, your entire garden might end up looking pretty bare when the bloom fades. A farmer knows their crops. They've learned the rhythms of the seasons, and they know the right plants to grow in their soil. They understand that focusing on tried and true, reliable crops is the key to long-term sustainability. The same principle applies to investing. While it's tempting to chase the newest trend, it's far smarter to focus on investments that have a proven track record of reliability. Historically, we've seen many examples of investors who jumped on the latest hot tip only to watch their investments burn up in smoke. Take the dot-com bubble of the late 90s. For example, everyone was obsessed with internet stocks, and people invested heavily in companies that didn't even have a solid business plan, let alone profits. The result? When the bubble burst, millions of dollars were lost. Those who focused on more reliable investments like established blue-chip stocks were able to weather the storm. The same happens today with trends like cryptocurrency. There are some who've made fortunes in digital currencies. But for every person who got in early, there are countless others who jumped on the bandwagon too late, hoping for a quick profit. It's not that the technology behind cryptocurrencies isn't interesting, it's that betting your entire portfolio on something that's highly speculative and volatile is like gambling with your future. So, how can you avoid this temptation? Start by remembering that true wealth isn't built on chasing after the next big thing. It's built on the steady cultivation of your investments. Diversify. Stick to investments that you understand. Don't let the latest flashy investment distract you from your core strategy. Just like a farmer who stays committed to their field, you need to stay committed to your investment approach. Think of Warren Buffett again. He's the quintessential example of someone who doesn't get distracted by the latest trends. He sticks to what he knows: solid businesses with strong fundamentals. He doesn't chase after the next hot stock. Instead, he looks for companies that have a proven history of success and strong future prospects. This is how you should approach your investments. 2. Instead of reacting to every market noise or chasing after the next tip, focus on building a portfolio of reliable, steady performers. Take a long-term view. And remember that successful investing is like farming. It's about sticking to your plan, tending to your crops, and waiting patiently for the harvest. There's no shortcut, no quick fix. Just steady, consistent growth. Now that we've tackled the temptation of chasing hot tips, let's talk about something that can make or break your investment journey. Consistency. A farmer doesn't just plant their crops once and walk away. They water, they nurture, and they keep an eye on their field every single day. In the same way, investing requires regular, consistent effort, not just in the beginning, but throughout the entire process, whether you're planting a seed or contributing to your investment account. Consistency is the key to long-term growth. Imagine a farmer who plants a crop but then decides not to tend to it for months. Do you think that crop is going to thrive? No, it's going to wither and die. It's the same with investing. If you make an initial investment and then forget about it, expecting it to magically grow on its own, you're setting yourself up for failure. A farmer knows that consistent attention is required to see the fruits of their labor. It's about showing up every day, putting in the work, and patiently letting things develop. The same goes for your investments. Whether you're contributing monthly to a retirement fund or adding to your portfolio, consistent action is crucial. Every time you contribute, you're giving your investments the nutrients they need to grow. Even when the market isn't looking great, even when it feels like your crops aren't growing as quickly as you'd like, your consistent effort pays off over time. In fact, many of the most successful investors are those who stick with a strategy of regular, disciplined investing. Warren Buffett, for example, has always been a proponent of long-term, consistent investing. He's not someone who jumps from one investment to the next. Instead, he sticks with what he knows, consistently reinvesting the returns from his investments to grow his wealth over time. Now, there's another important lesson here. Consistency doesn't mean constant action. A farmer doesn't need to be watering their crops every minute of every day. Instead, they have a schedule, a plan. Similarly, as an investor, consistency means following your plan, sticking to your strategy, but not overmanaging your investments. A lot of people make the mistake of constantly adjusting their portfolios based on short-term market movements. But this can be like a farmer who can't resist tweaking their crops every other day. This kind of overmanagement can actually hurt your investment's long-term growth. Think of it like this: regular, steady deposits into your investment accounts, combined with a well-thought-out strategy, are like adding fertilizer to your crops at the right time. You don't need to overdo it, you just need to show up regularly. Every deposit compounds, every strategy is solidified, and over time, you'll see the results. It's a slow process, but it's worth the wait. This consistency also helps with something else: market volatility. Markets will fluctuate sometimes wildly, but when you have a disciplined, consistent approach, those fluctuations are much easier to handle. The farmer doesn't worry every time the weather changes. They've built their farm on a strong foundation of solid crops, diverse fields, and well-planned strategies. Similarly, your consistent investments can weather the inevitable storms of the market. So, if you want to succeed in the world of investing, you have to be willing to show up consistently. You don't need to be perfect. You just need to keep watering your crops. By putting in the consistent effort day after day, your investments will start to grow, and eventually, you'll see the rewards of your hard work. The beauty of consistency is that, over time, it leads to results that no single, flashy move could ever achieve. We've talked a lot about the slow and steady process of growing wealth, but here's something that's just as important: knowing when to harvest. Just as a farmer watches their crops carefully and waits for the right moment to pick them, you, too, need to understand the importance of timing when it comes to harvesting your investments. This isn't about trying to time the market perfectly, because that's almost impossible. It's about knowing when it's the right time to reap what you've sown, and sometimes it's more about patience than perfect timing. Picture yourself as a farmer once again. You've carefully tended your crops, watered them regularly, kept an eye on the weather, and now the moment has arrived for you to harvest. But how do you know when the time is right? If you harvest too early, your crops won't be ripe, and they won't have reached their full potential. If you wait too long, they could spoil or lose their value. Timing, then, is about finding that sweet spot where the crops are fully matured and ready to be harvested at their peak. The same applies to your investments. It's easy to get caught up in the thrill of watching your portfolio grow. You may even start to feel like the market is never going to stop rising, and you may hesitate to sell, waiting for just a little more profit. But just like crops, investments don't grow forever. The market has cycles, and those cycles eventually lead to the end of a growth phase. The key is knowing when to take some profits off the table and when to hold on for more growth. It's about recognizing the signs that your investments have reached maturity and are ready to provide you with the return you've been waiting for. One of the biggest mistakes investors make is trying to time the market perfectly. This is like waiting for that one perfect moment to harvest your crops, hoping the weather will hold just a little longer. The problem is, if you wait too long, you risk losing everything when the market inevitably corrects itself. The best way to approach this is to have a clear plan for when to sell. It could be when a stock has reached a certain price target, or when the underlying fundamentals of a company change. It could even be when your portfolio has become too weighted in one asset, and you need to rebalance to maintain diversification. Take, for example, the real estate market during the housing boom of the early 2000s. Many people were riding high on rapidly increasing property values, but when the bubble eventually burst, those who held on to their properties too long lost everything. Those who sold early, on the other hand, were able to take their profits and reinvest them in safer, more stable assets. In the stock market, there are countless examples of investors who waited too long to cash out, only to see their gains evaporate in the face of a downturn. But even though we can't predict the perfect moment to sell, we can be strategic by setting clear goals, knowing your risk tolerance, and recognizing when your investments have matured. You can make informed decisions about when to take profits. It's not about guessing the market's movements. It's about knowing when your crops have ripened and having the discipline to harvest them at the right time. Let's also talk about one of the greatest investors of all time, Warren Buffett. Buffett doesn't try to time the market. He buys solid, long-term investments and holds them for years. When he sells, it's because the investment has reached its peak potential or no longer aligns with his strategy. He doesn't get distracted by short-term fluctuations. He knows that when the time is right, he'll harvest those investments, reinvest the proceeds, and continue growing his wealth. His approach is a great example of harvesting your investments when they've reached maturity, rather than hoping for an impossible peak. So, when it comes to your investments, don't focus on timing the market perfectly. Instead, focus on having a plan for when to sell. Recognize when your investments are ready for harvest, and make your decisions with patience and discipline. Like a farmer who's waited for the right season, you'll know when the time has come to collect your rewards. At this point, we've covered the big picture: patience, emotional control, diversification, compounding, and knowing when to harvest. But now, let's dive into the psychology behind it all specifically. The difference between a farming mindset and a gambling mindset. This is one of the most crucial distinctions in how you approach investing. Your mindset will ultimately shape how you make decisions, how you handle the ups and downs of the market, and, in many ways, whether you succeed or fail. So, let's explore the difference between treating investing like farming and treating it like gambling. When you think about gambling, it's all about the thrill, the rush of taking a chance and hoping for a big payoff. The more you gamble, the more you can get caught up in the excitement. You might make quick, impulsive decisions, betting on a roll of the dice or the flip of a card, all in the hopes of hitting a big win. But that's not how wealth is built. The psychology of gambling is rooted in risk-taking without understanding the consequences. There's a very real emotional high that comes from the possibility of winning big, and it's easy to get addicted to that feeling. But the odds are stacked against you, and eventually, the house always wins. The problem with this approach is that it focuses on short-term gains and instant gratification, while completely disregarding the long-term stability you need to build real wealth. Now, let's compare this to the farming mindset. A farmer doesn't go into the field expecting to strike it rich overnight. They go into it knowing that it will take time, effort, and patience to see results. They also understand that setbacks will happen. They can't control the weather, pests, or other external factors, but they can control how they respond. They prepare, plan, and focus on the long-term outcome. They approach their work with a sense of commitment, discipline, and a deep understanding that the fruits of their labor won't show up right away. When you approach investing with a farming mindset, you're not chasing quick wins. You're not trying to time the market or make risky bets. Instead, you're focused on steady growth, patience, and learning from the process. You understand that you'll have good seasons and bad seasons, but you're committed to putting in the work every single day, regardless of how the market behaves. This is the key to successful investing, understanding that you don't need to gamble to win. You just need to work your plan consistently, and the results will come. One of the reasons that people get caught in the gambling mindset is because of the fear of missing out, or FOMO. You've probably seen it happen. A stock is skyrocketing, and everyone around you is talking about it. It's tempting to jump in and get a piece of the action. But here's the thing: if you're jumping in just because everyone else is, you're gambling, not investing. Real investors understand that they don't need to chase after every shiny new opportunity. They stick to their strategy. They trust in their knowledge, and they're not swayed by the noise of the market. You've heard of Warren Buffett, right? He's the perfect example of a farming mindset in action. Buffett isn't interested in following the crowd or chasing after speculative investments. He's focused on companies with strong fundamentals, businesses that are steady, reliable, and have the potential for long-term growth. His mindset is that of a farmer focused on the long term, not the short-term noise. He doesn't get distracted by the fluctuations in the market. Instead, he keeps his eye on the horizon, knowing that with time, patience, and the right strategy, his investments will grow. When you adopt this farming mindset, you're more likely to make decisions based on logic and research, rather than impulse and emotion. It's about understanding that wealth is built over time, not overnight. It's about playing the long game and not getting sidetracked by the thrill of the quick win. Just like a farmer understands that the crops need time to mature, you need to understand that your investments need time to reach their full potential. So, next time you're faced with a tempting opportunity that promises a quick payoff, ask yourself, is this the mindset of a farmer or a gambler? And remember, a farmer always wins in the long run. Let's move forward now and talk about learning from the masters specifically, from someone like Warren Buffett. who treats his investments exactly like a farmer cares for their crops. Buffett's philosophy on investing is simple. Focus on companies with strong fundamentals, avoid chasing trends, and be patient. But perhaps most importantly, he advocates for the farming mentality. So, what can we learn from him, and how can we apply it to our own investment strategies? Warren Buffett doesn't chase after the next big thing or make quick bets on speculative stocks. Instead, he looks for businesses that he believes will be around for the long-haul, companies that produce reliable products and services with a proven track record of success. In many ways, his approach mirrors the philosophy of a farmer. Plant the seeds of good investments, nurture them over time, and wait for the harvest. Just like a farmer is patient with crops that take time to mature, Buffett's strategy revolves around a long-term, patient investment approach. Buffett often talks about buying stocks like buying a piece of a business. He doesn't just buy stocks for the sake of owning them. He buys them because he believes in the business and its ability to grow over time. This long-term vision is the key to his success. He doesn't care if the stock market fluctuates day to day. He cares about the long-term potential of the businesses he invests in. And just like a farmer who isn't concerned with the weather on any given day but focuses on the overall health of their farm, Buffett's attention is on the long-term horizon. Let's take a closer look at how Buffett's farming mentality translates into practice. One of his most famous investments was in Coca-Cola. Buffett bought shares of Coca-Cola in 1988, and he still holds them today. Why? Because he believed in the company's strong brand, its market position, and its ability to continue growing over time. He didn't get caught up in the daily fluctuations of the stock price. Instead, he focused on the fundamental strength of the business. Just like a farmer who understands the cycles of planting and harvesting, Buffett recognized that Coca-Cola had the potential to grow and provide steady returns for years to come. But here's the thing. Buffett isn't just sitting around waiting for his investments to magically grow. He's actively researching, carefully selecting companies, and making thoughtful decisions. He's not taking random shots in the dark. His decisions are based on solid research and understanding of the businesses he's investing in. So, how can you apply this to your own strategy? Start by understanding the businesses you're investing in. Don't just buy stocks because someone else is talking about them or because they're the latest trend. Take the time to research and understand what makes these companies strong and how they're positioned for the long term. Just like a farmer knows which crops grow best in their soil, you need to know which investments fit your strategy and goals. By doing your research, you can invest with the confidence that you're making a solid choice, not a gamble. Another thing we can learn from Buffett is the importance of staying true to your investment philosophy. It's easy to get swayed by the latest market trends or flashy opportunities. But Buffett teaches us that sticking to a disciplined, long-term approach is the way to true wealth. When everyone is chasing after the newest hot stock or the latest crypto craze, Buffett is focused on steady, reliable investments. He doesn't get caught up in the noise. He sticks to his principles. The best way to apply this to your own investments is by developing your own strategy, one that reflects your long-term goals and risk tolerance. Once you have that strategy, stick to it. Don't let the market's short-term volatility push you off course. Remember, a farmer doesn't go running around just because there's a storm. They prepare, they stay calm, and they wait for the season to pass. In the same way, you need to stay calm and focused on your long-term goals. Buffett's success is a perfect example of why treating your investments like a farm consistent, patient, and focused on the long-term works. By following a similar approach, you can build wealth over time and avoid the pitfalls of short-term speculation. Now that we've explored Buffett's farming approach to investing, let's talk about the nuts and bolts of managing your own investment portfolio, choosing the right assets to plant in your financial field. Just like a farmer carefully selects the best seeds for their soil, you need to carefully choose the right investments for your portfolio. The goal is to make your portfolio as resilient as possible, ensuring that it can weather both the good seasons and the bad. A farmer doesn't plant every crop in the same soil. Some crops thrive in sunny fields, while others do better in the shade. Some need a lot of water. Others prefer dry conditions. The same is true with investments. Different types of assets perform differently under various market conditions. That's why diversification is so critical. By spreading your investments across different asset classes, you're increasing your chances of having some part of your portfolio grow, even if other parts take a hit. Let's break down what types of investments you should be considering. In the world of investing, you've got your stocks, bonds, real estate, and commodities. Each one behaves differently and has its own strengths and weaknesses. For example, stocks are generally great for long-term growth, but they can be volatile in the short term. Bonds, on the other hand, are typically more stable but offer lower returns. Real estate can provide both income and long-term capital appreciation, but it requires more effort to manage. Commodities like gold or oil can act as a hedge against inflation, but they can be unpredictable. Diversification means that you're not betting everything on one crop. Just like a smart farmer will plant a variety of crops, you should spread your investments across different asset classes to balance risk and reward. This strategy helps you protect your portfolio during market downturns, while still allowing you to benefit from the growth of different sectors. But it's not just about diversifying your investments across different assets. It's also about being strategic in how you manage them. A farmer doesn't just plant their seeds and forget about them. They monitor their crops, adjust their care, and make sure they're growing as expected. Similarly, you need to keep an eye on your investments, rebalancing your portfolio as necessary. Let's say, for example, you've invested a significant portion of your portfolio in tech stocks, and those stocks have been doing well for a few years. However, the market has begun to shift, and tech stocks aren't performing as well. Rather than continuing to pile money into the tech sector, you might choose to rebalance your portfolio by shifting funds into more stable investments, like bonds or real estate. To mitigate risk, this is like a farmer recognizing that one crop is underperforming and planting more of the crops that are thriving. Rebalancing ensures that your portfolio stays aligned with your long-term goals, while adapting to market changes. An example from history. During the 2008 financial crisis, many investors who had their portfolios heavily invested in real estate saw their wealth evaporate almost overnight. But those who had diversified their portfolios into other assets, like government bonds or even international stocks, fared better. They still experienced losses, but they were able to protect a portion of their wealth. And when the market rebounded, they had the opportunity to grow again. That's the power of diversification. It gives you the flexibility to manage risk while still positioning yourself for growth. So, what can you take away from this? It's simple. You need to diversify your portfolio and adjust your investments over time. Don't put all your eggs in one basket. And don't be afraid to shift things around as the market changes. Just like a farmer constantly monitors their crops and makes adjustments, you should be doing the same with your investments. And remember, diversification isn't about gambling on one thing or the other. It's about creating a balanced, long-term portfolio that can thrive no matter what the market throws your way. Now that we've talked about building, nurturing, and managing a portfolio, let's close this journey with a look at the final reward of investing like a farmer: retirement. Much like the satisfaction a farmer feels when they've spent a long season tending to their crops and finally get to enjoy the harvest. The fruits of your disciplined, long-term investment approach will pay off when it's time for you to retire. And just like every farmer looks forward to a bountiful harvest, you, too, can look forward to enjoying the wealth you've spent years cultivating. But here's the thing, just like a farmer doesn't wake up one morning and decide to harvest without preparation, you can't just rely on the final payoff of your investments without thoughtful planning. The end goal, whether it's retirement or financial independence, is built on a foundation of consistent contributions, smart decision-making, and managing your portfolio wisely. This isn't about one big, lucky win. It's about knowing that the time and effort you've put in will come back to you when the time is right. A farmer's harvest is the result of months or even years of careful work. It's the same with your investments. If you've been regularly contributing to your retirement account, diversifying your assets, and letting your investments compound over time, your retirement can be a time to enjoy the fruits of your labor. Just like a farmer doesn't expect to make money from their crops immediately, you can't expect to retire comfortably unless you've been diligent with your financial planning and patient in watching your wealth grow. One thing to keep in mind is that retirement isn't the end of your investment journey. It's the beginning of a new chapter. Just like a farmer doesn't throw in the towel after the harvest, you need to continue managing your portfolio throughout retirement. After all, your retirement funds need to last you for many years, and the money you've spent years growing will need to continue growing to keep up with inflation and maintain your lifestyle. This means adapting your strategy as you get older, ensuring that your portfolio is still working for you even as you begin to rely on it for income. For example, as you near retirement, you may want to shift some of your investments from higher risk assets like stocks to more stable, income-producing investments like bonds or dividend-paying stocks. This is like a farmer planting a crop that's not only reliable but also yields year after year. While you don't want to take on too much risk in retirement, you also don't want to sit on your hands and let your wealth stagnate. A balance between safety and growth will allow you to continue enjoying the fruits of your labor throughout your retirement years. Warren Buffett, of course, is a great example here. Even though he's far from retiring, he's always said that the goal of investing is to set up a situation where your wealth can continue to grow without you constantly working at it. This long-term mindset is exactly what you should aim for in your retirement planning. Your investments should be working for you, so that when it's time for you to step back and relax, your portfolio can support you. When it comes to harvesting, remember that patience is key. You've put in the work, and now it's time to see the results. But the work doesn't stop after you've retired. Just as farmers must stay vigilant and adjust their strategies each season, so too must you continue monitoring your investments. Retirement is just the beginning of the next phase, where you enjoy the peace of mind knowing that your financial future is secure because of the smart decisions you made years ago. So, as you reach the final stages of your investment journey, whether that means retirement or simply financial independence, remember that the work, patience, and consistency you've shown will lead you to the reward you've been waiting for. Your harvest is ready, and it's time to enjoy the benefits of treating your investments like a farm rather than a gamble.